What's up, millennials? Today we're going to take a look at the Chipotle stock, CHPT. Nah, I'm just kidding, of course. ChargePoint is what we're going to take a look at. Yesterday, ChargePoint reported earnings, and today we're going to take a look at the increasing revenue, the growth strategy, and also the competitive advantage. So let's do it. If we take a look at the revenue, first of all, of Q1, we could see that they had revenue of $40.5 million, which actually was slightly above the guidance for this Q1, which was between $35 million and $40 million on the high end. So it's slightly above the high end of the guidance, always pretty good. And this was also an increase year over year of 24%, so that seems pretty good. The amount of revenue in Q1 was a little bit lower compared to Q4. That basically has to do with a lot of seasonality, or just a little bit of seasonality, because usually the revenue in Q1 is a little bit lower than Q4, so nothing to worry about in my opinion. And according to ChargePoint, we see growth in all sectors and not just in the North America, but also in Europe. If we then take a look at the guidance for Q2 and this full year, of course, the full fiscal year, then we can see that they expect to have a revenue of $46 to $51 million in Q2 of this year. And for the full year of 2021, or well, actually, I believe in this case, in ChargePoint's case, they have a fiscal year, which is going to be 2022. But that is going to be a revenue of $195 to $205 million for the entire year, which basically was as expected, as we have been seeing in the investor presentation for the last couple of months. Then when we take a look at the revenue diversity, if we can check it out by type, we can see that there's a difference between the charging system, so basically the hardware that ChargePoint provides, and the subscriptions and the other revenue, which basically is like energy credits and services, stuff like that. But we can see that the growth in revenue is mainly driven because of the network charging systems, which is the hardware again, but we don't see a very large increase in the amount of subscriptions and the amount of other revenue. So yeah, it's mainly driven by the hardware sales for now. And if we check it out by geography, we can see that almost all the revenue comes from North America right now. We don't see a lot of growth in Europe just yet, but it is definitely a part of their growth strategy in the future. Later on, we're going to talk a little bit more about this growth strategy in Europe. With regards to the percentage of total revenue, we can see that the amount of charging systems definitely accounts for the majority of the revenue, as we have been seeing in the previous section. We can see that in Q1 of 2020, so a year ago, that was about 60% of hardware of total revenue, and right now it is almost 66%. So definitely that is going to go up year over year. And we can see that if we go to gross margin of the charging system, so again, the hardware that ChargePoint makes and sells, we can see that the gross margin is going up pretty nicely year over year. The gross margin for the hardware was 5.3% last year, so Q1 last year, and right now it is 11.4%. So that is a pretty solid growth, basically a doubling of the gross margin on the hardware systems. So that's something we definitely like to see. If we then take a look at the subscriptions, we can see that last year in Q1, that was 27.5% of total revenue. Right now it is gone up a little bit, just a slight tiny bit, to 26.7%. And the gross margin is basically flat year over year, so no major changes there just yet. And the last category would be other. This again is energy credit services they provide. So this is definitely the tiny portion, or a small portion, of the total revenue. Last year that was 12.6%, and right now it is declining to 7.1%, but in my opinion, nothing to worry about. If we then check out the total gross margin, we can see that it has declined a little bit from 23.7% last year in Q1 of 2020 to now 22.8% in Q1 of 2021. And that is mainly driven again by the revenue growth, which mainly was in hardware sales versus the subscriptions. And hardware sales, of course, have a lower gross margin compared to the subscriptions. So that is definitely the reason for that. And a little side note here, because during the earnings call, they also released, or they talked a little bit about their guidance for the gross margins in the next coming years. They said that they were targeting a gross margin of about mid to high 30s, so mid to high 30% more or less, in the next 3 years or so. With regards to the liquidity, we can see that they currently have about $610 million in cash on their balance sheet, which also is driven by the sale of some warrants, 12 million warrants more or less, for a total of $73.8 million in cash. And the question is, where are they going to, or what are they going to use the money for? Well, it's mainly driven by R&D expenses, research and development. During the earnings call, they said that they are going to do a tremendous amount of R&D. It's basically the same as TPGY or EVbox. Hopefully TPGY is going to merge with EVbox. I was listening to an interview with the CEO of EVbox, and he also mentioned that the majority of their cash is going to go into research and development. So they're likely going to be using the cash for that. According to the CEO of ChargePoint, which is Pasquale Romano, we right now have a team of over 900 employees at ChargePoint, and 150 of them more or less are working in Europe, and that has actually doubled year to date. So at the beginning of this year, 2021, they had more or less like 70, 75 employees, I'm not entirely sure, but right now that has doubled to almost 150 employees in Europe. And all of these employees right now, because of the COVID situation, of course, are predominantly working virtually. With regards to the changes in the European market versus the North American market, we can see that in North America in 2021, people are expecting that there are going to be 540,000 EVs sold in North America this year compared to 2020, of course. But we can see that, well, that is a nice increase of 43% year over year. But on the other hand, if you look at Europe, there are people who are expecting 1.9 million EVs being sold in Europe in 2021. So Europe is definitely a very, very important market for the EV industry. And according to the earnings call, Europe is going to be a key part of their growth strategy of ChargePoint. Right now, Europe revenue, the European revenue in Q1 of this year was up for 140% year over year, quite a bit. And when they were asked about the targets, about the market share within Europe, because right now they have a market share of like 70+% in North America. But if you look at Europe, they are targeting a market share of more or less like 20% and probably higher over a multi-year period. So according to the CEO and also the CFO, Rex Jackson, that is probably a very conservative number, and they want to have that number way higher than 20%, of course. Someone after the earnings call also asked about the supply chain issues. Well, we haven't really seen any major problems so far, according to the CEO and CFO of ChargePoint, of course. But in Q1, there was some impact, which basically was mitigated. And yeah, as we've seen, the revenue was still above the high end of the guidance. So the Q1 results could have been potentially even higher had they not had these supply chain issues. Another interesting question was about the competitive advantage of ChargePoint versus the other companies out there, and they mentioned several options, several features of ChargePoint. For example, the more than decade of experience, that is of course very important, but they also have a capital light model because they don't operate the charging systems themselves, they just build and sell the hardware and get also recurring revenue for their subscription models. And of course, according to the CEO and CFO of ChargePoint, they also charge anything that rolls, as they call it. They are OEM neutral, so basically they can charge all the cars out there. It doesn't really matter if it's a Volkswagen, if it's a Volvo, it's a Polestar, whatever it is, they can charge anything that rolls. They also mentioned they have a complete solution, so the companies that want to work with ChargePoint can basically go to ChargePoint for basically whatever they want. They don't need to go to all kinds of different companies, but they can have this complete solution at ChargePoint. And the last thing they mentioned is that they are investing again, tremendous amount of money in R&D. And by investing in R&D, in research and development, they are of course trying to stay ahead of the competition. We haven't got an updated analyst rating just yet, but according to this website, marketbeat.com, we still have more upside to go. According to the analysts, right now the average share price and price target from the analysts is $35.50, and right now ChargePoint is trading, of course, way lower than that. So there could definitely be some more movements to the upside in the next coming weeks, next coming months. We can also see that there are no updated targets just yet, but according to the previous targets, these targets are all higher than the current share price. Someone, the Roth Capital, for example, is very bullish with a target of $46. We can see that Oppenheimer has a target of 39, Cowen 43. So these are all pretty high targets. And yeah, there could be some more upside to go. And then some very brief technical analysis. We can see that currently we are working on a slightly higher high compared to this high over here, which always is a good sign, of course. We right now are also above the resistance level of this blue box over here, which caught a lot of lows and highs in the last couple of months, actually. And we are also sitting above the 55 EMA, the exponential moving average, which is this white line over here. So that is all pretty good. The volume is right now increasing a little bit. We can see that the RSI is still above the exponential moving average on the RSI and still going back up to the upside. And the MACD is basically in a similar posture, also back above the signal line and still going up too. So I wouldn't be surprised if we are going to float up a little bit more to the next resistance level between more or less $34 and $35, which definitely is an important level because of previous support and previous resistance too. And this also coincides with the analyst rating of $35.50. So right now we can see that ChargePoint has a solid revenue growth. I like their plan to expand more in Europe to make that a key part of their growth strategy. And of course, they have quite a lot of cash to invest in R&D. So in the next coming weeks and months, I do think it's likely that we're going to see higher prices, not only because of the solid fundamentals, the solid growth of ChargePoint, also because of the analyst ratings of $35.50. And of course, the technical analysis is also looking pretty solid right now. So I'm very much looking forward to hearing from you as well. What price target would you give ChargePoint for the end of the year? Let me know in the comments. And with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye!